Corporate Finance, Management of Current Assets, Introduction. Don't make business decisions by chance. Use corporate finance. Management of Current Assets, Introduction. So we're thinking about those current assets, those more liquid assets, things that could include cash, accounts receivable, inventory, prepayments, and so on and so forth. Managing current assets properly can lead to a competitive advantage. So if we're better at managing our current assets, if we're better at managing our cash, for example, or accounts receivable and our inventory, that could give us a competitive advantage, which could, of course, increase the market share and the value to shareholders. So it's going to be important for us to do this, to manage our current assets well. The allocation of current assets is required for the current assets, which could include things such as cash, accounts receivable, inventory, securities, other kind of prepayments and whatnot. But these are going to be the main things that we're thinking about with regards to the current assets. Obviously, when you're looking at the balance sheet, the first grouping of the assets, the more liquid assets, will typically be grouped under the category of current assets. Now, clearly, if we're thinking about cash, the management of cash is going to be something that will be very important to us in order to be more efficient. Accounts receivable as well, because this also is intertwined with cash management, of course, because the accounts receivable will result in us receiving cash at some future point. So the interchange between the sales cycle, the accounts receivable, and the cash is going to be something that we need to think about and maximize our efficiency with. And then, of course, we have the inventory, which is going to be something, maybe one of the more less liquid of the current, or of the more liquid assets, right? Less liquid of the more liquid assets, and one that we're hoping to get a return on with the inventory, of course. So we're going to think about the inventory possibly a little bit different than we might think about the cash, even though they're both in the current assets section. We also might have other marketable securities. And we're thinking about other marketable securities that are going to be more liquid type of securities, but obviously not as liquid as cash. And therefore, the interplay between, say, cash and marketable securities could be important, because if we have more cash than is needed, then we might put some of that cash into securities in the hopes that we're going to get some kind of return onto it as long as we're holding on to the cash. So managing cash and securities. So if we're thinking about cash and securities, the primary concern is liquidity and safety. So you're thinking about kind of the interchange between the cash that we have on hand, how much do we need on hand, and the securities. Many times when you first start thinking about the business situation, we start to get into the idea that our goal, our objective is just to pile up cash and have a mountain of cash. But that, of course, is not the goal. Our goal is not to have a mountain of cash. Our goal is to generate revenue. And if we generate a lot of revenue and we get cash, then we have a couple things we can do with that. We can put that cash back into the business in the hopes of generating more revenue in the future, which will increase the value of the company. Or if we're not using the cash, then we would like to possibly give it to the shareholders, the owners, so that they can use it, right? So the goal of the business is to generate revenue, not simply to accumulate the cash. Our goal for cash actually within the business is to be as lean as possible with the cash, but have the cash that is going to be necessary. So the general objective actually with cash is not to have a lot of cash on hand, but have the cash sufficient to meet the current needs. So in other words, you don't want to have a lot of cash because you want it to be either invested or possibly go into the shareholders if it's not going to be something needed for business. However, you don't want to get carried away with that, because you do want to have sufficient cash in order to meet certain needs. I want to have cash on hand in case there's any problems with liquidity, so that we want to make sure that we can pay off any debts that are going to be available, and any kind of unforeseen circumstances that could happen in the future. We want to have the cash on hand and available to deal with those circumstances in the time frame that they need to be dealt with. And then the secondary concern is maximizing profits. And you can see why this would be the interplay between like cash and marketable securities. So if we, for example, if we had a lot of cash in the business, then once again, our goal is, well, do I want to hold on to that cash because I'm going to put it back in the business at some point in time? Or do I want to basically give it to the shareholders? If we're going to hold it onto it because we're going to use it at some point in the business, then the idea would be, do I want to put that money just in cash, or should I put it in some type of securities, possibly securities that are still more liquid, but which give me some type of return on investment, possibly some gain or some kind of interest on the investments. So our primary goal with the cash is not to get a return on the investment. Our primary goal with the cash on hand is to make sure that we have the cash that's necessary in case any problems happen. Secondary goal to that, if we have excess cash, would be to get a return on the investment if we can put it into some kind of marketable securities. Managing accounts receivable and inventory. So with accounts receivable and inventory, it's going to be a little bit different, even though these are going to be also current type of assets. The accounts receivable we want to manage in a similar way as we would manage any other kind of asset, and see, what's the value of us having the accounts receivable versus other type of investments, type of assets that we could have. So we'll have a higher profitability test for the accounts receivable, because our goal simply for the accounts receivable is not simply to make sure that we're holding on to the accounts receivable to be there in case of an emergency in the future, which is our primary reason to be holding on to levels of cash. The accounts receivable will, of course, be part of the business cycle. And as we make sales on account, the reason we make them on account and not for cash is because if we make them on account, then we're probably going to be making more sales in that system. And then when we manage our accounts receivable, our decisions are based around the profitability of the accounts receivable, having that asset on the books versus other things that we can be invested in. So it should meet the same return on investment, or ROI, criteria as any other decision. So we can apply that kind of concept of return on investment to the accounts receivable.